Look at your bank balance right now. That number isn't telling you the full story. Your statement might say $10,000, but if inflation is beating your savings rate, and it usually is, your real buying power is quietly shrinking. Here's a concrete example. If inflation is running at 3.5% and your savings account pays 0.75%, that's a gap of 2.75%. On $10,000, that's about $275 per year in buying power you lose, while your balance looks totally fine. And here's what makes it worse. Over 5 years, you could be down over $1,400 in real purchasing ability, and your statement still shows $10,000. That's the quiet bank tax. And today, I'm going to show you exactly how to stop it. Welcome to Cash Unmasked, where we expose the money traps that quietly drain regular people. In the next 10 minutes, you'll get the 3 moves to beat the quiet bank tax and a quick action plan. Most people measure money by the number on the screen. If it doesn't go down, they assume they didn't lose. Here's the myth. My balance didn't drop, so I didn't lose money. Here's the truth. My buying power dropped, so I lost value. Same money, fewer groceries. That's the quiet bank tax. So here are the 3 moves to stop it. Move 1, split your cash into 2 buckets with 2 different jobs. Bucket A is sleep well cash, emergencies, bills buffer, short-term needs. This money's job is access and stability. You might need it tomorrow, so you can't take risks with it. Bucket B is long-term money, cash you won't need for at least 12 months, ideally longer. This money's job is to grow over time so inflation doesn't slowly crush it. Concrete example, let's say you have $15,000 saved. You decide $6,000 is bucket A, your emergency fund covering 3 to 6 months of expenses. The remaining $9,000 becomes bucket B, longer term money. Now here's how to actually size bucket A properly. Ask yourself 2 questions. First, is your income stable or variable? If you're salaried with predictable paychecks, 3 months of expenses might be enough. If you're freelance or commission-based, lean toward 6 months. Second, what's your risk tolerance for uncertainty? Some people sleep well with 3 months saved. Others need 6 to feel secure. There's no wrong answer. Pick the number that lets you stop worrying. Once you split the buckets, you stop forcing one pile of money to do 2 jobs. Here's an illustrative example. Someone keeps $40,000 sitting in regular savings for years, unsure if they'll need it. Uncertainty wins. Over time, inflation quietly chips away at what that money can actually buy. If they'd split that money, emergency cash separate from growth cash, they could have at least partially offset the damage. The split itself takes 5 minutes, but that decision changes every financial choice you make going forward. Important, do not lock up your full emergency fund. Bucket A should be boring and accessible. Move 2, upgrade where bucket A lives. Goal, stop getting wrecked by default settings. Here's your starting point. Check comparison sites in your country for insured savings options. Look at whether your current bank has a higher yield tier, and consider reputable online-only banks that often pay more. When comparing options, verify 3 things. First, is it regulated and insured in your country? In the US, that's FDIC. In the EU, Deposit Guarantee Schemes. In the UK, FSCS. Every country has something. Verify what applies to you. Second, are the fees and access rules transparent? If you can't find clear information about withdrawal limits or how fast you can access your money, that's a red flag. Third, are there promotional tricks? Some accounts show a high rate, but it only applies to the first $1,000, or it's a teaser rate that drops after 3 months. Read the fine print. Here's your 30-second filter. When you're comparing accounts, regulated and insured, transparent access and fees. No hidden tricks. If you can't verify all 3 quickly, skip it and try another. Real example, if you keep $10,000 in bucket A at 0.75% while better insured options exist at 3% or more, you're leaving about $225 per year on the table. Over 5 years, that's over $1,100. Set it up once, then review it twice a year. Pitfall to avoid? Don't chase sketchy high rates from unregulated platforms. Emergency money is not your experimentation fund. Move 3. Make bucket B grow smarter than inflation over time. This is where the real inflation defense happens. Bucket A reduces the leak. Bucket B builds long-term value. Here's your framework. Diversify over concentration. Don't put everything into one hot investment. Automate over willpower. Set up transfers so money moves whether you feel motivated or not. Patience over panic. Headlines will always scream about crashes. Your system should survive headlines. Concrete example. Automate $50 a week into bucket B. That's $2,600 a year. Over 10 years, a growth-focused plan can end up tens of thousands higher than cash sitting still. That gap is what consistent action can create over time. Now the elephant in the room. But what if the market crashes right after I invest? That can happen. Market corrections happen. Recoveries happen too. If you're investing money you won't need for years, short-term drops matter less than building a system you can stick to. And here's the alternative. If you keep everything in cash waiting for the perfect time, you're almost guaranteed to lose buying power to inflation over time. That's not drama, that's math. Specific 2026 pitfall? Don't let headlines paralyze you. You'll hear, wait for central bank rate changes, then wait to see if we have a recession, then wait for more clarity. There's always a reason to wait. Don't. Build the system. Start the automation. Here's exactly how to set up automation. Option 1, payroll split. If your employer allows it, split your direct deposit 3 ways. Part goes to checking for bills. Part goes to bucket A. Part goes to bucket B. You never see it, so you don't miss it. Option 2, day after pay transfer. If payroll split isn't available, set up an automatic transfer in your banking app to run the day after your paycheck hits. Make it small enough that you won't panic, even $10 or $25 a week, but scheduled and automatic. The key is removing willpower from the equation. Good intentions fail. Systems work. Now here's your quick action plan. 3 steps in 10 minutes. Step 1, screenshot your savings rate. Open your banking app and find your current interest rate. Screenshot it. If you can't find it easily, write down rate unclear. That tells you something. Step 2, calculate your quiet tax using your gap. Take your savings balance and multiply it by your specific gap between inflation and your rate. Write that number down. That's your annual leak. Step 3, split the buckets mentally. Pick your bucket A number, usually 3 to 6 months of expenses based on your income stability. Everything else is bucket B. Do these 3 things today and you've removed the default settings that cause the quiet drain. Here's what this looks like in 1 year. You'll have upgraded your emergency fund, automated contributions to bucket B, and actually know where your money is going. Compare that to doing nothing. In 1 year, you'll have lost hundreds more in buying power. Quick recap. You split your money by job. You upgrade where emergency cash sits, and you automate long-term growth. 3 moves. That's it. If this video helped you, subscribe to Cash Unmasked. Every week I expose one money trap that costs regular people hundreds or thousands. You now know what the quiet bank tax is, how it works, and exactly how to stop it. The question is, will you act on it this week? 5 years from now, that decision is worth thousands of dollars. Thanks for watching. Now go split those buckets.